Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Her websites, jugglingdynamite.com and venablepark.com. Welcome back to the show, Danielle.
Hello, Jim.
Danielle, is cash coming back?
I think cash has always been very popular. Has it not, Jim? Has it not always been a good thing to have?
I don't know. Steve Miller wrote the song, Your cash is nothing but trash, but I think he meant something different. But when I say cash is back, having money in a bank account or buying bonds, is that becoming a trend again?
Okay, so basically, the world is in the middle of a cash crunch. That's the first thing. The pandemic, of course, shut down a lot of business and a lot of revenue, and a lot of people were laid off. And so there was this drop in income everywhere, which created a cash crunch, which is why governments stepped in, which is why central banks stepped in to try and pump liquidity into the system, into the financial system, and into actual bank accounts of individuals. Now, what's happened with a lot of that cash went to pay down some existing credit that people had. Some of it in the first few months went into savings. We saw that both in America and Canada, and a good amount of the cash is still kind of piled up in savings accounts. And what we've seen in the last few months is that a fair amount of it in people that don't have a lot of money in particular, the young crowd have been enticed by social media into these gaming style websites where they follow, people who are trading and having, stock picks and options and all these things, which we've discussed in the past. So some people have really doubled down on the idea that they might win their way out of this financial disruption or problems that they're having, and they've really become sort of casino-like in their activities. So there is a fair amount of cash that has gone into financial markets in that capacity, and it's created a lot of volatility, a lot of price spikes, roving kind of booms and then busts in various areas. It's also gone into commodity speculation. So I think this is a very important theme. What we saw since March of 20, the U.S. dollar peaked out when risk assets were falling in March of 20. And then it began to decline as central banks, especially the U.S. Fed, stepped in with a lot more bond buying. And this has typically always been weakening for the benchmark currency when the central bank opens the floodgates and pumps a bunch of cash into banks and takes bonds off their balance sheets and puts them on the Federal Reserve balance sheet. So that's been happening, and it weakened the U.S. dollar all the way from March of 20 into the end of December of 20. And during that time, because I've described this many times of the teeter-totter, where you have the U.S. dollar as the benchmark currency, the dominant trade currency in the world, where most transactions are conducted internationally in the U.S. dollar, it's seen as a safe haven in times of trouble. It's the most liquid, it's the deepest bond market. So that's what happened when the pandemic hit, and then when the central bank stepped in and pumped the liquidity, the trade went the other way. So the U.S. dollar weakened on that flow, and things like commodities, which are on the other end of that, emerging markets, stocks, they received inflows as people sort of sold some of the places they'd gone in the crunch, in the safe haven crunch. They sold some of that and went into these risky assets. And the basic idea was that things had gotten very bad. We had the worst GDP, of course, contraction that we'd seen since the 30s in first quarter of 20, and that the comparables, when you get that kind of severity in terms of a plunge in the inflation rate, which went profoundly deflationary in the first quarter of 20, when you get that kind of thing with a plunge in growth, that ultimately the rate of change starts to look more favorable. In other words, not that things are great, but that, people start thinking, well, surely they have to get better than that, especially with all this stimulus intervention that's been taking place. And so we had this reflation trade, which saw a lot of funds go into things like commodities, some of this excess liquidity, again, for a trade. So I think we have to be very, very careful today that we don't construe, longer-term investment prospects with the trades that happen because of the highly computer-driven, liquidity-seeking, gambling that pervades right now at this time in financial markets. And so, as commodities have spiked in the past few months, as the U.S. dollar weakened into the end of last year, you saw this jump in spending. So for things like, food, for things like energy, we saw the price of oil come up dramatically. The price of cars has increased a lot because of the supply chain shutdowns that happened with the closing of the world economy and fits and starts over the last year has made shortages in certain things like plastics. And we've seen copper prices go back up to the highs that they were in the last cycle top in 2008. So lumber prices have doubled. We're seeing that, we have had a big spike in new home construction in Canada back to the peak we saw in 2008 and the 1990 peak before that. And this has really been an unexpected fact that has been driven by people wanting to move out of big cities and get more space around them, sort of pandemic driven, but also with this, the central banks and the world and flooding of liquidity, we saw borrowing rates plunge, right? So the price of a mortgage, for example, in Canada, you could get, a 5-year mortgage at less than 2% for the first time. So all of these factors have really had a bunch of sort of cheap money chasing certain themes. One of them being housing, certainly in North America, another being commodities for this trade. And then you saw the sell-off, as I've said, in treasuries, in government bonds, as funds began to think, well, surely things are going to be better for a while. Surely we should, get some opportunity for growth from such low points. They left things like treasuries. So as they leave things like treasuries, what happens, though, is that interest rates rise. So the yields on those bonds rise as their prices fall. And this is an unfortunate side effect, right? Because the very time that central banks have been saying, like the U.S. Fed yesterday in its call, said, we have no intention of raising rates till 2023. We just want to assure everyone that, we want the labor market to repair itself. We know that's going to take a matter of years, not weeks, and we have no intention of raising rates. Well, at the same time, the bond market just continued to sell off. So treasury bonds have come up in terms of the yields because in August, treasury bonds had appreciated so much on the fear of all the bad news in the world. And then when the selling starts to come, the yield on those bonds, for example, the U.S. 10-year bond, the yield on it has appreciated from 0.5 in August to 1.76 today as a high. That's a 200 and almost 50% increase. And the same thing has happened in Canada, where the 5-year bond, which is actually quite impactful to our Canadian mortgage rates, has increased 252% in terms of its yield. So you're starting to see mortgage rates creep up. In the U.S., that's the 30-year mortgage 30-year mortgage rate has moved, above 3%. It's now about 3.3, where it was 2.2 back in January. So this is a very dramatic increase, and it's all connected to this trade mentality around, things not being so bad in the first half of 21 as they were in the first half of 20. But now we get to the tricky bit, because now we have rising borrowing costs, a population that's more indebted than ever before, and we're not just talking households, we're talking governments, obviously, but also corporations. The most debt has been borrowed at these really low rates over the past 6 months. than ever. So now we're in a situation where people have higher living costs because of the spike in commodities and home prices. They have now rising interest rates and higher debt carrying costs because of that, as they locked in all this debt at low rates. And we still have a very broken labor market. So, and a lot of businesses closed and a lot of businesses permanently closed. So now we get into the harder forecast because we're looking at the second half of 21, where the expectation is that we won't need as much intense government infusion into households and businesses because things are getting better, aren't they? But in fact, we're still in this very negative, difficult churn. And although financial markets have greatly overshot the expectations of what kind of growth and earnings and healing we're going to see in the economy, the reality is that trends have really stacked up to go back into a disappointing phase where we have lower growth in the second half than we saw in the first half. And this is why cash is going to be coming back as a very preferred asset class, because when you have, the fact that bonds have sold off is one thing. It's bad for the indebted that rates have gone up, but actually it's better for savers who have cash to put to work in some of the safer paper because yields have gone back above 2.5% or 2.25 relative to 0.5 point last summer. So cash is something that, has great optionality in these markets. And what you typically see when you get into the slowing rate of inflation period again and this disappointing growth or comparables relative to the first to the last 6 months, what you tend to see is that you get a repricing in risk assets. You get the U.S. dollar starting to rise again, which in fact, since the start of the year, the U.S. dollar has been, slowly moving up with some pullbacks, but those pullbacks are always to a higher low. So it's still in an uptrend since the start of the year. And indeed now we're starting to see the ripple effects into commodities, where, for example, the price of oil is plunging again today, down 7%. And a lot of these commodities that have had record long speculators in them. So again, this isn't about the global demand being strong and consuming all these goods for producing products for consumption. This is about a lot of cheap money that had nowhere else to go and drove up the price of things and incented capacity and storage and stockpiling of all these things. And now we get the reality that we have a lot more supply than the world's still wanting. And so you get these big price corrections. And I think that's what we're likely to see as we head into the second half. We could still see, if each time rates rise a little further here, and we could see rates rise a little further, it inflicts more pain. It re-strengthens the U.S. dollar, which inflicts more selling on the commodity side. And I think this is where we're heading in the latter half of the year.
We'll have more with Danielle Park right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Danielle Park. Danielle, there's $10.5 trillion in corporate debt. Is this a disaster looming on the horizon, or are there opportunities here?
Well, there'll be opportunities for investment, which is the exciting part of it. But first we have to go through the clearing part of it, right? Which is the people that have, again, this indiscriminate buying of risky paper just because they had, there was a lot of speculation going on with this cheap money in the banking system, and companies who could borrow, even junk status companies were able to borrow money with, at 3% and change in this environment, when historically they've been more north of 8% when they have to go to the market for debt. So really what they've done is they've gorged themselves on money, which they've either stockpiled thinking it'll help them get through a rough patch in the economy over the next year or two, and or they've used it for share buybacks, and or they've used it for compensation for their executives. A lot of it won't be productive, and so the only good debt is actually debt you take on that will improve your income so that you're able to pay that money back easier. When things are done, when money is borrowed for personal consumption, for inefficiencies, for, something that doesn't improve your cash flow and productivity, it makes it much harder to pay it back over time, especially if your rates go up, right? So again, corporate debt is this huge market that the Fed has, threatened that they will buy corporate debt if necessary, just as they buy some treasury bonds to try and bring down rates. But the size of it is so massive, and they really don't have a mandate to go in and bail out companies that are, junk companies that have borrowed their brains out and really mismanaged themselves, and they're now at the verge of insolvency. Not everybody is going to be considered too big to fail, if you know what I'm saying. And so what happens is that we go through this cathartic cleansing period, which has been so extended a long time coming because of all these interventions that have gone on. But now you've got this labor economist, Janet Yellen, at the head of the Treasury in the United States. We don't have the same administration that we had Mr. Mnuchin from Goldman Sachs in there, doing everything possible to be Wall Street friendly. Now you've got, this new administration and the people that are pointing to these key roles. The focus is, at least the talk, or the perception or the appearance they want, is that they're trying to help the worker. And so at the fringe, you're seeing a lot of adjustments that are not as corporate friendly, right? Not all about how do we get corporate profits even higher at the expense of the working class, but everything seems to be more about how do we make it at least look like it's fair for the working person? How do we try and level the playing field a little bit? Not that it'll ever be purely level. But anyway, this is the zeitgeist of the time. And so I think it's going to be harder for corporations to get away with, paying, like, for example, did you notice that in the UK, the High Court had recently ruled that Uber drivers were in fact employees entitled to benefits and vacation pay, and this month Uber has negotiated, in fact, agreements with the drivers to do exactly that, so that they will have the status of employees and benefits and protections of employees. So this is really kind of a game changer, because that is a global model. That's the app model that has really dominated the last decade, where everything has gone to the app owners and investors and, I always say like a mothership in the sky where cash flow gets sucked up and everybody else is left with less. And now that tipping point is happening. So again, it just means that it's going to be, I think, higher costs, higher tax for companies, harder to make, net profits. And that's going to make paying back the debt that's been borrowed that much harder for them. And especially because corporate debt moves with the equity market, as I've said many times, when you get a massive repricing in a corporate debt because, people start to fail and default and can't pay back, or because you get a rising rate environment like we're starting to see now, you get a massive repricing in that credit. So that suddenly people who thought it was, good as cash, which it never was, but they were acting as if it was good as a government bond, so to speak, and paying too much for it and therefore getting very little interest income off of it because they were overpaying. Now they have a reprisal where they say, this stuff is not as safe as we thought it was, or we may not get paid back, or, the price of the paper starts to fall and they don't like that, or they get margin calls because we're at record margin debt, in the world right now again. So people have borrowed a ton against their rising portfolios, both to fund consumption and spending and things like buy cars, as well as to buy more financial assets and things like Bitcoin and all this stuff we've seen all inflate together. So this is all really tied together. But when equity prices start to come down, corporate debt does too. And this is back to this cash theme, because there is an opportunity there, like we saw last in 2009 when you were able to buy corporate debt that had fallen by 50%. Now those companies, many of them didn't go bankrupt. They were able to keep making their payments or reconsolidate their debts, but ultimately the bonds that you bought, were maybe trading 50 cents on the dollar, and you could then buy them, and your yield would be more than 8%, and ultimately they mature at par. So you get a capital gain on top of the interest income. So this is what really exciting investment opportunities look like. And again, if you're holding them when everybody else is in the madness of crowds, you don't have the liquidity or the principal safety, right? So everything declines, and then you're one of the ones that's under either margin pressure, having to sell low, or psychologically battered, rather than someone who has the cash and the plan to buy off those weak hands.
We'll have more with Danielle Park right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, will the Canadian housing boom last forever?
Yeah, sure, forever and ever and ever. And you know what? Then soon a house, the average home price will be $3 million, and there won't be a single soul that isn't already in the market that will be able to lever themselves into it. And I think we're getting very close. The numbers right now are capital STUPID, honest to goodness. It makes no sense on an average household income basis, even with low rates, and never mind the fact, as I say, that mortgage rates have trended up. And when people are this stretched, any increase in carrying costs becomes very difficult to absorb. And it's not just, of course, the carrying costs when interest rates rise, but the fact that people have bought such expensive housing, really it ties to things like insurance costs are higher because your principal that you're insuring, the residence you're insuring is higher in value, so your insurance costs are higher. Property taxes tend to ramp up with the price of the properties. So you're all in, your carrying costs for housing gets to be just off the charts, and I think we're there. I've done a lot of looking around. I live north of Toronto, but nationally, the gains, in some areas more than 30% just in the last year. This is all part of this pandemic inflation trade, where again, cheap rates, lots of government intervention to help people get cash, whether it be to income or whether it be through very minimal down payments in the housing market, ALEC, Canada Mortgage and Housing, that taxpayers backstop so people can get into the housing market with hardly anything down. All these things have really driven this, this sort of panic into trying to get out of the very urban centers. But when you look at the stats, Canada's population growth just in 2020 was 0.4. Our replacement is, you need something north of 2% to replace the population. We had the lowest immigration. We've had the highest deaths. We have an aging population. We have, people that when they've paid so much for housing, no matter what their age group, they typically can't, have much extra cash for other things like savings. So we have a population that is, really cash strapped thanks to very exorbitant housing and doesn't have a lot of funds for other things. So all of these things ultimately end up being deflationary or disinflationary in terms of spending capacity going forward. Both the demographic shift, the aging, and the young people not being able to come in as first-time home buyers, ultimately that is a nail in the coffin of perpetually rising home prices. And also just people, a lot of people with the suffering from under savings and low rates are saying to themselves, we need to downsize our costs so that we can afford to be retired. And so those factors all together, I think, suggest that we could very much see at least a stagnant housing market for a decade or so. I mean, we got to get somehow mean reverted here, whether it is in people say, well, the housing market could never go down. Well, if it went up more than 30% a year, Jim, it could certainly go down 30% over a period of time. And just that kind of correction in itself, people don't understand the math until they're actually in it and live. But, there was a story about, a couple that had a $450,000 cash set aside for a down payment. Their household income was more than $200,000 a year. They were on paper an excellent candidate to try and buy a house, except they're trying to do it in the, GTA area just north of Toronto, where there's all these bidding wars on properties and price indiscriminate buying, and you have to put in an offer without getting any property inspection whatsoever. Like, you're not allowed to have any conditions. You're not allowed to say you have a condition on financing even. Like, it's absolutely bonkers. So these people are having to put in offers that leap 25 and 30% over the ask price in the process. Well, just to do the math, if you were trying to buy a property for $1.3 million and you put $450,000 down, if it was to correct back to where pricing was just a year ago, you would almost all but extinguish the entire $450,000 down payment. Your equity would reduce to something like $86,000. I think that's what people don't appreciate. That will have a profoundly different psychological impact than the 30% appreciation that people think they've got in the last year. But again, if it's like we won a lottery as property owners, right? It's great. We won a lottery. Except if you don't want to sell or you don't have anywhere cheaper to go so that you can cash out and put money in the bank, it's actually just a bogus thing. It's like a ticket came up but was never claimed, and ultimately it expires worthless.
Rent or own? People are always debating that. And something that Ross Kay from The Wealthy Homeowner told me was that if you buy a house for $1 million over 25 years, do you know you're going to spend about $1 million maintaining and improving that house?
Yeah, well, I mean, obviously, there's many reasons to want to own a home, and most of them are emotional. People want to have a place to raise their family. They want to feel secure. They don't want to have to move because a landlord decides to sell, and all those are very valid reasons for wanting to have your own home. But there are definitely financial calculations that should be done. It isn't always the right financial decision to buy a house, and especially right now when rents in many areas, for example, in the city, in the big cities, rents have come down. In Toronto, for example, some rents are down 15 to 20% over the last year. So if you're looking at a scenario where you really have to do the math, because if your end goal is to hopefully own a home someday, but you're in the process of saving up for that home, and you can either overstretch now and lock yourself into another 10, 15 years of mortgage payments because you're in some bidding war paying more than, much more than you should for a house that you really can't afford, versus staying put where you are in a rental situation that is a fraction of the cost per month, and you can save a lot more. Obviously, sometimes that is the right financial decision to make, and it doesn't mean that you're, shut out forever. I mean, everyone's talking about how young people will never be able to buy a home if they don't get in now. I disagree with that. I think that there's never been a time when a housing market like this hasn't corrected significantly, and typically over 10 to 15 years after you go through a crazy period like we have right now, where pricing just makes no sense. It's very likely that you could see pricing come down considerably in the next few years, and or be, the same price as it is today 10 years from now. And during that time, people could be, building up their savings and waiting for a better opportunity for buyers. Right now, it's all about a seller's market, and it's a horrendous time to be a buyer. So anytime you're in an environment where price has gone parabolic, where, everybody's desperate to get in, that's when you really ought to be thinking about standing back, building up your dry powder, and being much more conscious in your decision making. Going against the herd often will end up being the best financial decision you've ever made.
Danielle, thank you so much for being part of our show.
Hey, thanks, Jim.
And for all the HowStreet.com listeners, we have a special treat. Friday, March 19th, I'll be hosting a webinar with Rick Ackerman. editor of the newsletter Rick's Picks. And Rick has a particular point of view that a lot of people don't think is going to happen. So many economists are predicting that we're going to be facing hyperinflation. Rick, you have a different point of view. Why do you think deflation is going to be the big problem we face in the future?
Well, first, thanks for helping me to put this together, Jim. I do think that the end game will feature deflation. We've got such an acute mania going on in all investables right now that even the bulls must be forced to see that it's not going to end well. So as far as I'm concerned, the bad ending is going to be deflation rather than inflation. And although that sounds counterintuitive because of all the credit stimulus that's going on, I think in the end it's debtors that are going to get stuck, not lenders. And that implies in deflation, it implies a strong dollar, a crushing burden of real debt. It implies that we're never really going to get out of our mortgages by being able to pay our lenders in $100,000 bill snide. So that's where I think things are going, and I'm in a very small minority with that scenario.
And Rick, what's the website they should go to?
Yeah, that's rickackerman.com. If you go to rickspicks.com, you're going to find a New York-based pickle and relish vendor. So rickackerman.com is where you want to go. You can sign up for 2 free weeks of everything I offer, including a couple of great trading rooms for just $1. So that's just click Start Trial at the top of the page, rickackerman.com.
So join us Friday, March 19th for a webinar with Rick Ackerman about deflation. It starts at 10 o'clock Pacific, 1 o'clock Eastern Time. My guest has been Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Her websites jugglingdynamite.com and venablepark.com. If you have any questions for Danielle or any of our other guests, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.